What's going on with mortgage rates? Stay tuned. Hi there, thanks for watching this week's video. It's Shirley with Shirley's Real Estate Group, John L. Scott, and this is the BS Real Estate Show, buying and selling real estate, that is. So I was recently asked what's happening with mortgage rates. Lyle, this video is for you. Also, I just had a conversation yesterday or the day before in regards to home prices and mortgage rates. Caleb, I know you're on your lunch break, so this video will help answer your questions more in detail too. So let's jump right in. A couple of quick facts. We've never been in a year where the interest rates, the average 30-year fixed, has doubled in 1 year, and it's been the fastest rise in mortgage rates since they started tracking them over 50 years ago. But I want to break down where rates are at right now and a couple of very interesting things that I think tip the hat to where we're going into next year. Going forward, what's really going to be the determiner of the market is the Fed's ability to control inflation. Let's break down where rates are at right now and where experts are pointing them going into the next year. This first quote here from Lawrence came out: a return to a normal spread between the government borrowing rate and the home purchase borrowing rate will bring the 30-year mortgage rate down to around 6%. As of early December 2022, the average 30-year fixed is right about 6.5%. We've seen a little bit of relief over the last few weeks, but what Lawrence is referring to here is the 10-year Treasury, calling it the government borrowing rate. For almost 50 years, the 30-year fixed rate has moved in unison with the 10-year Treasury yield. So if you want to know where mortgage rates are heading, watch the 10-year Treasury yield and the spread between them. You see in the middle of the screen here, the average spread has been about 1.7% or 170 basis points. Literally, if you take the 10-year Treasury and you add 1.7% to it, you would then get the 30-year mortgage rate, or in that range. It's been on average a spread of 1.7%. Every time we've talked about mortgage rates this year, we've used that graphic that just shows them shooting up as the year has gone by. It's been a market that experts and forecasters have never seen before. A market that's doubled and the fastest move in the last 50 years. But if you look at the 10-year Treasury, this is a look at the 10-year Treasury from December 2021 to December 2022. What do you see? Just that rise up. The 10-year Treasury has been rising kind of up and down, but the trend has definitely been up. Now let's talk about that quote from Lawrence. He said a return to a normal spread. That's the spread between the 10-year Treasury and the 30-year fixed. Let's break that down so you know what that means. I'll use this graphic right here and pose the question, why are mortgage rates not at 5.5%? If we start at this box on the left, if you were to go back to 2000 through 2021 and look at the average 10-year Treasury and the average spread of 1.7%, you see the 10-year Treasury at 3.49% in the blue box, 1.79% in the orange box, gives you a mortgage rate of 5.28%. That would be the average between 2000 and 2021. Well, where are we at today? I mentioned before that mortgage rates are about 6.5%. On an average 30-year fixed, well, today or as December 1st, the 10-year Treasury yield is at 3.5%. The spread of 2.99% gives us that 6.49%. Now today, if the spread were normal and we're in the range of 3.7%, looking at the box on the right, and we have the 1.79 spread in the Treasury yield like we've had historically, we would be at about 5.5% in the average 30-year fixed. You might ask, why is the spread much higher right now than it's been historically? The quick answer is, one, market volatility no doubt is driving rates higher. And second, the investors that determine these rates know that everybody that's buying right now will likely refinance these mortgages, so they're charging a higher premium for them. Ali says this: the housing market is expected to face continued uncertainty heading into 2023 as consumers, financial markets, and policymakers work through their respective challenges in today's economy. No doubt we're in an uncertain market. There's a lot of volatility and a lot of questions on the economy, on geopolitical events, the war in Ukraine, and all those things causing uncertainty. If we take a look at this quote from Barry, because we see a slowdown and we see the inflation comparisons start to become more and more favorable, you'll start to see that inflation number move lower, lower, lower. As a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5% or below 5% within the next 6 months. Now we'll see if Barry is right about that, but no doubt as the market becomes more certain going into next year, we should expect interest rates to go down. Now, I don't think we're going to see anything in the 3s or 4s, probably likely maybe in the high 5s, low 6s. But no doubt as we see more of that, we should expect for interest rates to get a little bit of relief as well. I'm going to be attending a webinar by Barry on Monday, so I'll pass along any insight I get on that. I can't believe this year is almost over. I want to wish you and your loved ones an amazing holiday season. Well, that's what I have for you this week. If there's a topic you'd like to hear about or an idea for a future video, like a question or challenge you're having, please let me know. If you like the content, don't forget to smash the subscribe button so you get future videos, and subscribe as well. And I'll see you in the next video.